Hey, Steve Saretsky here. As always, the Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value or entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. This week, just want to touch on the sort of what I'm seeing anecdotally, the foreclosure market, the Chinese real estate market, etc. See how that all ties into the macro picture. So I think first and foremost, obviously, in the last couple of weeks, have been highly touted as Chinese New Year, Lunar New Year, so to speak. I think that's come and passed now with really seasonal uptick in that. I think it was largely overhyped, overplayed, particularly in the pre-sale development space, offering numerous bonuses and allowances based on Chinese New Year. But I can tell you, not only through the data, but also through anecdotally, it has pretty much come and passed. That Chinese money is just simply not there, at least to the extent that it was in 2015, 2016. That was, again, the single largest credit expansion in financial history out of China. Those capital outflows poured into Vancouver and propelling, in particular, the luxury housing market. But what we've seen now is through China's capital controls. I mean, they've just recently increased their capital controls as well. Now upping their jail time for anyone that's running underground banking operations. So that's going to continue to ripple through into global property markets. But that's just the gist of it. And the other gist of it is there's no beating around the bush or trying to fancy it up. Chinese economy is slowing, and it's slowing significantly, and it has a lot less to do with trade war than I think people believe or want to believe, or that mainstream wants to tell you, that as soon as a trade deal is initiated, everything's going to go back to normal. A trade deal isn't going to revert global slowdown, as we've seen already. Italy in a recession, Germany teetering on the brink of a recession. One could certainly argue that China, their GDP in 2018 ticking in at 6.6%, lowest in 2 decades, is arguably a recession in their terms. So that's particularly hampered the luxury housing market here. It's just interesting to see all the headwinds coming from China. I just finished this book. It's called China's Great Wall of Debt. It's written by a guy in the finance space that lived in China for 15 some odd years and basically exposed their economy for what it was. It was essentially a lot of malinvestment, particularly into real estate. And I think it highlights a lot of points that people should be cognizant of, particularly that China is attempting to deleverage. But when you have that much credit, particularly funneling into real estate, which is ultimately an overcapitalization, basically a malinvestment into real estate, it's going to start to expose your bad debts, and there's no real painless way that you can simply deleverage without some significant pain. And so I think that's what China's sort of grasping with right now. But again, just to see all the cross collateralization through real estate loans, etc. I think it's a very fascinating thing to watch. I mean, there's recent data coming out that suggests 65 million apartments in China are considered vacant. And that really ultimately goes with prices when they're rising exponentially. And you can apply this back in here to Vancouver, and I can speak firsthand on this. When prices are rising exponentially, so in Vancouver we've seen prices rising, 20-30% a year, there's very little incentive, particularly for a wealthy investor, to actually rent it out. What's the point of getting your $2,000 or $3,000 a month rent when your condo is going to go up 20% appreciation per year? So there's little incentive. So I think we have sort of this hidden inventory of supply that's going to help alleviate the low vacancy that we have. And I think we're seeing that not only through the vacancy taxes and speculation taxes that are implemented to incentivize people to rent them out, but I think you're also seeing that through now in the fact that prices are not only not appreciating, they're depreciating. And so I think it creates an additive incentive for people to help mitigate those losses in the form of renting them out. And that's been my conversations with multiple property managers in the city, that we're certainly seeing some rent pressures alleviate. And that also comes back into the cyclical nature of things. Generally, when the economy is in its expansion phase, is when wages are growing, unemployment rate is falling, the economic prospects are great, and this ultimately encourages rents to rise. People can afford to pay more for rents, and then ultimately when the cycle winds down, the unemployment rate eventually bottoms. It then will start to tick higher, as we're starting to see it has bottomed and it's come off its cycle lows of a 43-year low cycle low in the unemployment rate. That starts to rise, and that is going to, that starts to put basically a ceiling on the rent prices as well. And what you'll eventually see is unemployment will rise and we'll enter a recession. And that's just like a normal, cyclical nature of it. And I think it's important to understand that, the cyclicality of it, because particularly when I meet with, developers who a lot of times I would argue are very smart people, they've made a lot of money, they've been very successful. But despite that, many actually don't understand the cyclicality of things and how they all tie in together. And so I think, it's especially when you've had a 20-year housing bull market. I mean, it's been very, very, very difficult since basically 2000 to actually lose money in real estate. It's been very difficult. Even in the 2008 financial crisis, the Vancouver housing market went through basically a 9-month correction. That's not a long period of time. If you can weather the storm for basically 9 months, you were able to get through that period and move on. So market hasn't really been tested. And same thing for developers and realtors. It's basically a one-way track to profits, massive appreciation. So I think now we're going through a massive cyclical change, not only in the short-term cycle here as this 10-year expansion winds to a close, but I think we're also entering a long-term debt cycle, as Ray Dalio would talk about it. The Canadian households have not deleveraged, similar to a lot of the US, Europe in 08, 09. So I think Canada and Australia are these two households that are very indebted. They did not deleverage in 2008. Their home prices continue to rise, as well as their level of indebtedness. And I think that is coming to a wall. And it's interesting because I was in a foreclosure course at the Real Estate Board of Greater Vancouver earlier this last week. So there's 40 or 50 realtors there. You can get a pretty good scope of how people are feeling, market sentiment, and particularly from the guy that was actually doing the course as an active realtor. He does about 40 to 50 foreclosures per year over the last 25 years. So the guy does just rakes in the listings from the banks in terms of getting foreclosures. So he's very comfortable with the process and has good insights on that space. And I think what's interesting is just to hear him say, I typically do about 40 a year, and starting in 2015 it sort of dipped down to 30, and then the next year was 20, and the year after that was 10. He says in 2018 I did one foreclosure, one single foreclosure. He's like, in the 25 years I've been in business doing foreclosures, it was the worst year ever for foreclosures. Again, this guy did one single foreclosure basically in the Lower Mainland. And already this year, he's done 5. And we're not even 2 months into this market yet. He's already done 5. So I think it's clearly what we're seeing is the foreclosures, as the cycle winds to an end, you're seeing the sales dip off substantially. You're seeing the inventory rise. You're seeing the interest rates rise. Your debt service payments are rising faster than your wage growth. And so your debt servicing is at, I believe it's a 10-year high in the debt servicing ratio in Canada. And so that's going to continue to weigh on this. And basically what happens with interest rates is generally you take about a full year to actually rip through the market, to actually come onto and place pressure onto households to work their way through the economy. So even the Bank of Canada's last rate hike is not even actually baked into the economy yet. And despite that, you're seeing a significant slowdown, and you're starting to see households fold as a result of that. So I think that's important. It's going to be very fascinating. Like I said, I think there's going to be a lot of opportunity here moving forward. So it's not necessarily to be negative or pessimistic on the market, but just understanding the cyclicality of that phenomenon. I think it sets you up for success. And so, I do worry for a lot of the developments. I think that clearly there's going to be a significant drop, and I think it's going to surprise a lot of people. This is a significant drop off in new housing starts in 2019. Basically, the developers are really struggling with hitting their pre-sale targets. Remember, if you're building a pre-sale condo in Vancouver, you generally have to pre-sell about 65% of the units in order to get construction financing to go ahead and build these condos. So what happens right now is they're offering more incentives, bonuses, but they're really struggling to hit their sales targets, and so a lot of these won't get off the ground, and now you're stuck with a developer that has a huge mortgage on a parcel of land a lot of the times, not all the times, but a lot of the times, and they're going to have to offload them. That's just the reality of the nature. So you'll see the foreclosures start to increase in that space as well. And I think there's, with that being said, I look typically into housing cycles. What you generally see is you see the suburban markets, they tend to get hit the hardest, particularly the blue collar cities. And I think we're starting to see that already in areas such as Langley and Abbotsford, which I would argue are probably the two lagging and most euphoric markets in Greater Vancouver in 2017, 2018. I think it was in 2018 in March, or sorry, yeah, it was at end of, I believe it was the end of 2017 actually. At one point, Langley and Abbotsford condos saw price growth of 49% year over year. So you basically had this just rampant price inflation in those markets. And since that time, you can see here is the rate of change and price growth of Langley and Abbotsford condos. What you can see is a sharp deceleration in the rate of change on price growth. So what this basically means is that from the peak, Langley condos have dropped 10%, which is like late spring 2018, and Abbotsford condos technically peaked out in June of 2018, and they're now down 14% from their peak price. Now, they're not negative year over year because that's just like you're just comparing it to 1 month in the year. But what you will start to see is this data is already baked in, these price declines are already baked in. So you'll start to see the media now reporting in the news headlines the negative year-over-year declines in Fraser Valley condos, particularly in Langley and Abbotsford. That is already baked into the cake, regardless if you somehow see some miraculous uptick spring market. These price declines are in fact already baked in. They're a lagging indicator. You can take that to the bank. So I think that's the main thesis for this week, is watching and understanding the foreclosure process. I think it's definitely a lagging indicator. Again, remember, a rolling loan carries no loss. As long as you're able to continuously refinance or sell your home for profit because the market always goes up, you cannot bear a loss. It is almost impossible to foreclose. But unfortunately, when home prices stop rising, that's when the debt becomes due, and that's when the foreclosures start to increase. So I'll just give you one last example before I end it for this week. A common fallacy amongst people that I hear is that, well, people in Vancouver have so much equity, they just won't sell. They just won't sell. They have too much equity. Why sell in a down market? And while that may be true for a lot of the times, distress selling rarely ever comes in the form of and it's never an equity problem. It's always a cash flow problem. So what happens is the unemployment will go up, someone will lose job or their hours will get cut back. Most people live paycheck to paycheck, and that becomes a problem with the ability to service a mortgage. So one example was, I looked at a home in Port Moody. It was up for foreclosure. So I'm looking at this, I pull all the mortgage documents. This guy buys a house in Port Moody in 2003, pays $400,000 for it. The house literally triples in value, so it's now worth 1.2. And he somehow has taken on 3 mortgages on the property. One at prime minus 0.25, first mortgage. Second mortgage is at 12%, and the third mortgage was at 17%. And he somehow owed $1.4 million in mortgages. He had $1.4 million in mortgages, and it was not cross-collateralized. It was just $1.4 million on his own primary single-family residence. So again, and this guy is it's a court-ordered sale. He's going to foreclosure. So I don't know what he did with all that equity. I don't know how he somehow managed to get himself, 3 mortgages, but it somehow happened. And normally, in a normal circumstance, this guy would not foreclose as long as his home price kept going up. Some private lender would continue to issue him new debt. So you basically continue, what you basically do is you continue to issue new debt to service the existing debt. So it's almost like it's considered what we call Ponzi financing. And this continues to work until the asset prices no longer rise. All it takes is them to flatline, and then it becomes a problem. Nobody wants to issue new debt. The debt becomes due, and that's where the problems lie. So yeah, that's the thesis for this week. Watching that moving forward, I think it's a story that's starting to pick up, but I think we'll start to see that closer towards the end of 2019, where we start to see those numbers really start to ramp higher. So anyways, that's all I got for this week. Otherwise,